Welcome back to the Deep Dive. Today we're tackling something that often feels really complicated, but maybe, just maybe, it's simpler than we think. We're talking about financial freedom.
That's right. And specifically, we're diving into J.L. Collins' book, The Simple Path to Wealth. It actually started as letters he wrote to his daughter. Pretty cool origin story.
It really is. And the core idea, well, okay, let's unpack this. What if building wealth isn't just for, the super rich or Wall Street types? What if it's actually accessible to anyone?
That's the promise, isn't it? Building a life with more freedom, more confidence, more peace, all based on some pretty timeless principles.
Exactly. We'll be hitting the key stuff. Index funds, this concept of FU money, which we'll definitely explain. Smart spending, avoiding debt, the fundamentals.
What's fascinating here is how Collins just cuts through all the noise. The financial world loves complexity, often because, well, complexity is profitable for them.
Right. They make it seem harder than it needs to be.
Yeah, and Collins simplifies it brilliantly. This book has sold millions, translated into tons of languages. It clearly strikes a chord.
So our mission for this deep dive.
To pull out the really actionable stuff, the insights, the examples, the analogies that make financial independence feel, well, achievable for you. We want you walking away with practical steps, understanding how these ideas fit today, and feeling, empowered.
Okay, let's get started. Section 1, the foundational truths. Money, freedom, and that silent killer debt. First big idea. Money. It's not the root of all evil, not something to ignore. It's a tool. Maybe the most powerful tool you have for actually building the life you want.
It's not about greed.
No, it's about freedom. Freedom to leave a job you hate, maybe travel, help out family,
Yeah.
or just sleep better at night, knowing you're secure.
Absolutely. And if you don't get a handle on it, money can end up controlling you.
That's the danger.
And it connects right back to why Collins wrote the book. His daughter basically said, Dad, I get money's important, but I don't want my life to revolve around it.
I think most people feel that way.
Totally. People have dreams, right? Building things, teaching, creating, just living peacefully, not getting buried in spreadsheets.
But here's the catch.
Yeah, the catch is if you neglect it, you're vulnerable. Slick salespeople, confusing jargon, experts who make things sound complicated so they can get rich off you.
It's a minefield.
It can be. Collins cuts through it with this core truth, and it's so good. The simpler your investments, the better your results.
Simple equals powerful.
Exactly. He says complex and expensive equals ineffective. Simple equals powerful equals wealth building. Love that.
So how do we get this freedom without the obsession? Collins boils it down. 3 simple rules.
Okay, lay them on us.
1, spend less than you earn. Obvious, maybe, but crucial. 2, invest the difference. And 3, avoid debt like it's a disease.
That's it.
That's basically it. No complex strategies needed. It's all about consistency. Doing these simple things over and over.
And this isn't just about, getting a big bank account number. It's about building real wealth, which he defines as freedom, the freedom to choose.
That's the ultimate goal, having options. Okay, let's tackle that 3rd rule. Debt. The silent thief. Collins uses this great analogy. Imagine debt as a backpack you're forced to carry, and every loan, every credit card balance adds another brick.
Oof. Yeah, that paints a picture.
It weighs you down, not just financially, but emotionally, too. All that stress, the limited choices.
And think about his quote, what you own ends up owning you.
Right. That fancy car, the huge house. Are they really adding to your freedom? Or are they just locking you into payments, into stress?
It forces you to ask that question. Is this thing helping me build freedom, or is it owning a piece of me?
So important.
And if we zoom out, debt has become so normal. It's everywhere.
Totally normalized.
But normal isn't always healthy, is it? We're talking over $12 trillion in American consumer debt. Mortgages, student loans, credit cards, car loans.
It's staggering.
And it actively destroys wealth. It shrinks your lifestyle because money goes to interest, not living. It chains you to your job. It piles on stress, anxiety, guilt, shame. It can even feed bad habits like shopping to cope.
It steals your mental energy, too, just worrying about it.
Exactly. It makes avoidance the default. Collins lists 6 ways it destroys wealth, and they're all spot on. Debt is not a tool. It's a thief.
So what if you're already carrying that backpack full of bricks? What's the way out?
There's a strategy. Collins breaks it down by interest rate.
Okay.
If the interest is really low, say under 3%, you can probably pay it off slowly while still investing extra cash. The returns on investing will likely beat that low rate.
Makes sense.
If it's in the middle, like 3% to 5%, it's more of a judgment call. Do what feels best, maybe a mix of paying down and investing.
But the danger zone.
Over 5%. Collins calls this termites in your financial foundation.
Oh, wow.
You got to pay that off aggressively. It's eating away at your future wealth.
And sometimes, even if the math isn't perfect, just getting rid of debt feels better, right? That peace of mind factor.
Absolutely. Peace of mind often trumps perfect math. So the plan is simple, though maybe not easy.
Step 1.
List all your debts. Get it all out in the open.
Step 2. Cut spending. Ruthlessly. Goodbye. Expensive coffees, maybe.
For a while, yeah. Cut the non-essentials. Third, rank those debts by interest rate, highest to lowest.
Okay, highest rate first.
Pay the minimums on everything else, but throw every extra penny at that highest interest debt until it's gone. Then take that payment amount and attack the next highest.
The snowball effect, but for debt reduction.
Exactly. And what not to do is crucial too. Don't pay someone else to fix it with consolidation schemes. Don't just pay off the smallest debt first for a quick win. Focus on the interest rate.
Right, tackle the most damaging debt first.
Yes, and the discipline you build doing this, Colin says it transforms into a superpower for building wealth later.
I like that, the superpower. What about so-called good debt? Things like mortgages or maybe student loans.
Collins urges extreme caution. Business loans. Super risky. Mortgages. Okay, potentially, but buy the least house you need, not the most you can possibly afford.
Because bigger house equals bigger everything else. Taxes, maintenance.
Exactly. More bricks in the backpack.
Yeah.
And student loans. He calls them especially dangerous.
Why especially?
Six-figure debt is common now. It usually can't be discharged in bankruptcy. It follows you forever. They can even take your Social Security. He calls it a moral crisis, turning young people into modern-day indentured servants. Harsh words, but he feels strongly.
Wow, that's a heavy perspective.
It is. The final message on debt is just crystal clear. It's not your friend. It's not normal. It's not a tool. It's a thief.
So the action step if debt is weighing you down.
List it. Cut spending. Attack the highest interest rate relentlessly. Stay focused. You weren't born to be a slave to payments. You were born to be free. Every dollar paid off buys back that freedom.
Powerful stuff. Okay, let's shift gears to something more empowering, perhaps. FU money. This term sounds a bit aggressive, maybe, but it's not about being rude.
No, not at all.
It's about having options. Real options.
Yeah.
It's that moment you realize, wait, I don't have to put up with this. This terrible boss, this unreasonable client, this soul-crushing commute. I can walk away.
Exactly. It's not necessarily retire early and live on a beach money, though it can lead there. It's more like, I don't have to take your crap money.
Yeah, that sums it up.
Yeah.
Comes from a James Clavell novel, Noble House, apparently.
And why does this matter so much now?
Well,
Because most people lack those options. They're living paycheck to paycheck, maybe deep in debt. They feel trapped.
vulnerable.
Very vulnerable. And honestly, those in positions of power, employers, lenders, advertisers, they kind of count on your financial fear. FU money removes that fear. It gives you leverage. It gives you control.
Cullen shares some really personal stories about this, doesn't he? His own journey.
He does, and they're really illustrative.
He started working super young, like 13, selling fly swatters, collecting bottles. He actually enjoyed watching his savings grow. But then reality hit hard. His dad got sick. The family business failed before he was even 16. His college savings vanished.
Oof. Tough lesson early on.
Yeah, it taught him the world isn't financially safe. That safety net can disappear fast. His first real taste of this FU money power came when he was 25.
Okay.
He'd saved $5,000, which was a huge deal back then on a $10,000 salary. He wanted to travel Europe for 4 months. Boss said no to unpaid leave. So what did Collins do?
He quit.
He quit right there. And guess what? The boss blinked. Offered 6 weeks unpaid instead.
Wow. Having that cushion gave him the power to call the bluff.
Exactly. He took the 6 weeks, biked across Ireland and Wales. He says the $5,000 didn't just buy a trip, it bought him freedom. Taught him he'd never be someone else's puppet again.
That's a powerful realization at 25.
And it wasn't just once. He quit jobs 4 more times over the years. Sometimes for travel, sometimes to switch careers, sometimes just to breathe.
That FU money kept giving him options.
One story that really stands out is when his daughter was young, he stayed home with her. Watched Lion King on repeat, apparently.
Been there.
His wife was thinking about staying on too, but felt hesitant. He told her essentially, we have FU money. We don't need new cars or a bigger house. What matters is this time with our daughter.
And she did stay home.
She did. And he calls it the best purchase they ever made. The
Yep.
craziest part. For 3 years, neither of them worked a traditional job, and their net worth actually grew.
Okay, how did that happen? That's the dream, right?
Right. Well, it comes down to those core habits.
Okay, let's break those down. What enabled that level of freedom?
3 things consistently applied. 1, saving 50% or more of what they earned.
50%, that's huge.
It is. 2, staying completely out of debt, no car payments ever. And 3, investing simply and consistently in low-cost index funds. He gives a shout out to Jack Bogle and Vanguard there.
So, save aggressively, avoid debt, invest simply. Even when they made mistakes, and he admits losing 50K on a bad mining stock.
Ouch. Mariah International, I think it was called.
Right. Even with missteps, those core habits kept them on track. Which raises the question, what could this mean for your life? More options.
Absolutely. Collins have been semi-retired since 2011. Sleeps in, travels, blogs, writes, or doesn't. His choice.
And his biggest regret through all this?
Worrying too much. He says, I spent too much time worrying about how things might turn out. Worry steals today's joy.
That's profound. Money isn't the end goal.
No. But it buys you the time, the space, the freedom to figure out what is.
So, the action step here.
So start building that FU money cushion today. Even if it's just $500 to start or $5,000.
Yeah.
The amount isn't the point initially.
It's the commitment. You're not just saving cash, you're buying your freedom piece by piece.
Cut expenses, save hard, avoid debt, invest simply.
You're buying your life back.
Okay, section 3. Let's talk about the engine that drives a lot of this, the stock market. Collins is clear. You need to be invested in the stock market, but, and this is key, you're not tripping to beat it.
Right. You're trying to ride it.
Exactly. No picking individual stocks, no trying to time the market dips and peaks, no chasing hot trends.
So what do?
You invest in a simple index fund. Own a tiny piece of basically every major company out there.
Like the whole U.S. market.
Pretty much. And yes, the market will drop, it'll crash sometimes. The headlines will scream, sell, panic, it's over.
Been there, seen that.
Your job. Ignore the noise. Keep investing your planned amount. And when the market is down, think of it as a sale. Buy more if you can.
It sounds so simple, almost. Boring.
Maybe boring is good. Because what's fascinating is how this simple, boring strategy consistently outperforms most of the smart money.
It's the power of compound growth, right?
Totally. Collins gives this amazing example. $12,000 invested in an S&P 500 index fund back in 1975.
Okay.
Reinvesting the dividends through all the ups and downs. By 2015, it grew to over $1 million.
Wow. After all the crashes and recessions in that time.
Yep, that's an 11.9% average annual return. Even investing just $150 a month, like $5 a day, over that same period.
What does that get you?
Over $1.1 million.
Okay, that's staggering. That's the snowball effect.
It really is. Starts small, but builds incredible momentum, which leads to redefining wealth. Maybe millionaire isn't the right target.
Right, it's kind of an arbitrary number.
The real question Collins asks is, can everyone achieve financial independence?
And his answer?
A huge, enthusiastic yes.
Financial independence isn't about $1 million necessarily.
No, it's about having enough invested so the returns cover your living expenses. Enough to live the life you want on your terms without needing a paycheck.
He gives these great contrasting examples.
Yeah.
There's the early retirement extreme guy living super frugally on $7,000 a year. He only needed $175,000 invested to be FI.
Wow. Okay.
Then there's his friend who got an $800,000 bonus but was burning through $175K every quarter, felt broke, nowhere near FI.
Because it's not about how much you make.
Exactly. It's about how much you keep and invest. Wealth is relative. It's about control.
So back to the formula.
Spend less than you earn. Invest the difference. Avoid debt. Repeat.
He even shows how someone earning just $25K a year could potentially do it.
Yeah, living on half, $12,500, investing half. In about 11.5 years, they could have over $317,000 invested. That could generate $12,500 a year passively from the investments FI achieved.
And if they let it keep growing without adding more.
Another 10 years.
Yeah.
Nearly $1 million, potentially generating $38,000 a year. It's mathematically possible.
So if it's that simple, why don't more people do it? What holds them back?
Well, there are powerful forces working against you.
Like advertising.
Absolutely. Constant bombardment. You need this new phone. You deserve this luxury vacation. Can't afford it. Put it on credit.
They blur the line between wants and needs.
Totally. Collins tells that funny story about his friends saying you couldn't raise a kid properly without a high-end video camera.
Ah, right. As if our parents didn't manage.
Exactly. Recognizing the difference between true needs and manufactured wants is crucial for freedom.
So it takes a mindset shift.
A huge one. From spending to saving, consuming to investing, short-term thrills to long-term peace. You don't need a huge salary. You need discipline, living below your means, and patience, letting compounding do its work.
So a practical step here.
Track your spending, find just one thing to cut back on, invest that difference monthly. Even $50 makes a difference over time. It's about starting.
Okay, but investing means dealing with market ups and downs. The roller coaster.
Definitely. You gotta buckle up. Collins learned 5 key things over decades.
Go on. Nobody can predict the market. Not the gurus. Nobody.
Give up on trying to time it.
2, it's still the best wealth building tool we have. 3, long term, it always goes up, despite the drops.
History backs that up.
4, because you can't predict it. Just stay invested. And 5, get your money working ASAP. Don't wait.
That if only thinking waiting for the perfect dip is a trap. It's just fear disguised as strategy.
And fear and greed drive mistakes.
Especially fear. And let's be clear, the market will crash again. It's a fact.
Expect it.
Expect pullbacks, corrections, panic, but know that historically, recovery and new highs always follow. You have to be mentally prepared to see your portfolio value drop, maybe significantly, and not freak out. That's the ride.
And the question, should I wait for the crash to invest?
Total fallacy. You'd have to time it perfectly twice, selling high and buying low. Nobody does that consistently.
Time in the market beats timing the market. Every time.
Look at the Dow Jones S&P 500 history. Through wars, recessions, bubbles, the long-term trend is undeniably UP.
So tune out the noise. The talking heads on TV yelling crash or boom.
Exactly. They're selling ratings, not sound advice. The real question isn't when to invest, it's whether you have the emotional fortitude to stay invested when things get scary.
It's more psychology than finance sometimes.
A lot of it is controlling emotions, staying consistent. That's the secret sauce.
Action step.
If you're waiting on the sidelines, start now. Even small amounts. Let time work for you.
Okay, but why do most people actually lose money in the market if it generally goes up?
Great question. Collins points to 4 main reasons. 1, trying to time the market. We just covered that. People buy high in euphoria, sell low in panic.
Opposite of what they should do.
Right. Reason 2, thinking they can pick winning stocks. The odds are tiny. Even pros fail. Collins admits he tried and realized it was mostly luck.
Been there. 3,
Picking winning fund managers. Most actively managed funds charge high fees and still don't beat the simple index. Van Vine's study showed 82% failed over 15 years.
and you pay those fees whether they win or lose.
Exactly. And reason 4 is focusing on the foam instead of the beer.
Explain that one.
The beer is the real value the underlying business is growing. The foam is the daily price swings, the headlines, the drama. Media loves the foam. Investors get distracted by it.
So the path to winning.
Stop trying to outsmart it. Buy broad-based, low-cost index funds. Hold them long-term. Ignore the noise. Let compounding work.
Time in the market, not timing.
That's the mantra. Action step. Automate investments into VTSAX or VTI. Set it, forget it, let it grow.
What about the really scary stuff, like the 1929 crash, the big ugly, as Collins calls it?
Yeah, we have to address that. 1929, the Dow dropped 90%. Took 26 years to fully recover.
Right.
Terrifying.
Lesson 1 from that, never invest borrowed money in the market. Ever.
Absolutely critical. But we need context for 1929.
Okay.
1, you had to be exceptionally unlucky, investing everything right at the peak. 2, for most people who kept working, it was a huge buying opportunity. 3, prices fell everywhere. Deflation, so money bought more. 4, it's incredibly rare, and safeguards exist now.
What about the other monster hyperinflation, like Zimbabwe?
Also extremely rare in developed economies. And stocks, owning pieces of real businesses, actually tend to hedge against inflation better than cash. VTSAX helps protect you there too.
So it comes down to risk tolerance again.
What kind of risk can you handle? Fear a once-in-a-century event, or join the long march of wealth building?
The core principles hold.
Spend less, invest the difference, VTSAX, avoid debt, stay the course. Action step. Write this down. Market crashes are normal. I will not panic. I will keep investing. Keep it visible.
I need that reminder sometimes. I remember Black Monday in '87. Dow dropped 22% in one day.
Brutal.
I panicked. Sold near the bottom. Missed the recovery. Painful lesson. Collins says you need guts more than a finance degree. You need to be tough.
That quote about staying the course with a side dish of panic is so relatable.
Yeah. So let's really understand why the market always goes up long term.
Okay, zoom out. Stocks mean ownership in real companies. Apple, Starbucks, whatever. VDSAX means ownership in thousands of them. You're betting on the whole U.S. economy.
Why does that bet usually pay off?
Two big reasons. One, the market is self-cleansing. Losers fade, blockbuster. Winners rise, Netflix. Constant evolution. But this only works if you own the whole market through an index fund.
Good point. And two,
Businesses are built to win. Think of all the energy, innovation, competition, entrepreneurs, workers, dreamers fighting to succeed. You're harnessing that collective drive.
but it's not a smooth ride.
Never. Terrifying drops, crises, media panic. Your job is just to be patient, be tough, stay the course.
Action step here.
Make investing automatic. Recurring buys into your index fund. Don't check it daily. Don't react to headlines. Trust the process.
Okay, let's move into section 4, the toolkit. How do we actually put this simple path into practice? The core message again, simple is powerful. Simple is easier. Simple makes you wealthy.
Right. The financial world thrives on complexity because they profit from it. Complex products equal higher fees.
The secret they don't want you to know is that you probably don't need most of that stuff.
Exactly. The more complex an investment sounds, the more likely it is to cost you money,
Right.
and the more it makes for the company selling it to you. This section is about saying, no thanks, I got this.
So before investing, Colin says ask yourself 3 key questions.
Laid them out.
1. Where are you on your journey? Building wealth, earning, saving, or preserving wealth, living off investments. 2. How much risk can you handle emotionally? Can you sleep if the market drops 20%? 3. What's your timeline? Investing for years or decades?
And these answers guide your strategy, and they can change over time, right?
Definitely.
Important mindsets here, too. 1, there's no risk. Cash loses to inflation guaranteed. Stocks are bumpy but build wealth. You just choose your risk type.
Good point. Cash isn't truly safe long term.
2, age doesn't perfectly equal stage. Life isn't linear. 3, FU money, we talked about this, gives you power and options throughout. And 4, long-term is probably longer than you think. You might need money for 30-plus years in retirement. It needs to grow.
Okay, the essential toolbox. You said it's simple. How simple?
Just 3 tools. That's it.
Tool number 1.
VTSAX, Vanguard, Total Stock Market Index Fund. Your growth engine. Owns thousands of U.S. companies. Builds wealth. Fights inflation.
Tool number 2.
VBTLX, Vanguard, Total Bond Market Index Fund. Your smoother ride. Reduces volatility, provides some income. Stocks are the gas pedal, bonds are the seatbelt.
Okay. And tool 3.
Good old cash. Your cushion, daily needs, emergencies, flexibility, peace of mind, keep it in a high-yield savings account.
VTSAX, VBTLX, cash. That's really it.
That's the core. How you mix them, your asset allocation, depends on those questions you asked earlier. More VTSAX for growth and bumps, more VBTLX cash for smooth and slow.
No perfect formula, just what lets you sleep.
Exactly. Action step. Think about these 3 buckets: growth, VTSAX, stability, VBTLX, curveballs, cash. Adjust the mix based on your stage, risk tolerance, and goals.
Now, about index funds like VTSAX. Some people think it's, well, lazy investing. Boring.
Yeah, that misconception comes up a lot.
But Collins argues index investing isn't lazy, it's brilliant. It's doing what works.
He credits Jack Bogle, Vanguard's founder. Bogle said after 60-plus years, he never met anyone who could consistently beat the market. Not once.
So why does indexing win?
Because picking winners is nearly impossible long-term. Indexing owns everything, guaranteeing you get the market's return, which beats most pros.
Why do people resist it then?
Psychology, mostly. Ego, I'm smarter. Misunderstanding, confusing average market return with mediocre. Media loves hero stories, not slow wins. Not understanding fees, 1% fee can devastate returns. VTSAX is practically free, 0.05%, wanting the thrill and being brainwashed by the industry telling you need them.
Yeah. The Bruce Lee test. Am I Warren Buffett?
If not, keep it simple. Action step. Open a low-cost brokerage account. Invest in a total market index fund. Don't be a hero.
Okay, let's talk bonds, VBTLX. The quiet cousin.
Right. Stocks are the highway. Bonds are the scenic, slower road. They smooth out the ride.
Provide income, stability, protection against deflation.
Exactly. Bonds are basically loans to companies or governments that pay you interest. Less volatile than stocks. The smart way to own them is VBTLX, thousands of high-quality bonds in one fund. Diversifies risk automatically.
Do we need to worry about interest rates and stuff?
With an index fund like VBTLX, not really. It manages all that complexity for you. The biggest risk for bonds long-term is inflation eroding their value. But they provide that crucial stability when stocks are down.
So essential for balance, especially later on.
Definitely. Action step. Add bonds via a low-cost index fund like VBTLX. Adjust the amount based on your risk tolerance and life stage. Younger, fewer bonds. Closer to retirement, more bonds.
Okay, let's pull this together. Portfolio ideas, building wealth versus keeping it.
Two simple blueprints. Portfolio 1, wealth accumulation. This is for your prime earning years, maybe 20s to 40s, the recommendation.
100% VTSAX.
Pretty much. 100% VTSAX. Put all your eggs in that one huge diversified basket and let it ride. Nothing beats stocks long term, but you must be tough enough to hold through crashes.
That 200 months from 1975 turning into $1.5 million shows the power.
Exactly. The hardest part is psychology staying cool when the world freaks out.
Okay, Portfolio 2, wealth preservation, for nearing or in retirement.
Here you add stability. Colin suggests maybe 75% VTSAX, 20% VBTLX, bonds, 5% cash, growth from stocks, stability from bonds, peace of mind from cash.
And you rebalance that mix.
Yeah, maybe once a year. Takes maybe 2 hours. Adjust the ratio if you want more safety, like 60-40 stocks, bonds, or more growth. No perfect ratio, just what helps you sleep.
Both portfolios work because they're simple.
Low cost, diversified, ignore noise, regular investing. Time. That's the recipe. Action step. Pick a simple portfolio. Invest consistently. Don't panic. Stay the course.
Choosing that mix, finding the balance.
Mm-hmm.
It feels personal.
It absolutely is. It's that dance between growth and stability. Stage 1, building wealth. Go heavy, maybe 100% on stocks, VTSAX. You have time. Dollar cost averaging works in your favor as you invest regularly.
Stage 2, preserving wealth.
Add bonds, VBTLX, for stability. Maybe start around 80-20 stocks bonds, but life isn't neat stages. You might freelance, retire early, but work part-time. It's flexible.
Simplicity versus a bit more effort.
Zero hassle. 100% VTSAX. Little more work. Add 10-25% bonds, rebalance annually. Or use a target date fund, TRF.
TRFs adjust automatically, right?
Yeah. Pick your retirement year. They do the rest. Slightly higher fee, but brain dead simple.
Knowing yourself is key. Will you panic sell?
Crucial question. How much flexibility do you have? Can you tighten your belt if needed? That allows more risk, more stocks.
When to add bonds isn't an exact science then.
No. If you have a fixed retirement date, maybe start shifting 5-10 years prior. If flexible, stay mostly in stocks longer. Rebalancing. Doesn't matter exactly when, just be consistent. Collins uses his wife's birthday.
Easy to remember.
Where to hold them. Generally, bonds in tax-advantaged accounts like IRAs, 401ks, because their interest is taxed as ordinary income. Stocks, VTSAX, are more tax-efficient and regular taxable accounts.
Don't need to obsess over rebalancing frequency.
Nope. Tiny performance difference. Jack Bogle didn't even do it himself. Build your balance. Be consistent, thoughtful, honest with yourself.
What about international investing? Advisors always push that.
Collins pushes back. He argues against dedicated international funds for 3 reasons. 1, extra risks, currency fluctuations, looser accounting rules, higher costs. 2, you already own the world via VTSAX since big U.S. companies earn globally. 3, global markets are more connected now, so the diversification benefit is shrinking.
So VTSAX gives you enough global exposure already.
That's his argument. Keeps it simple, low cost, avoids extra risks. If you really want direct international, Vanguard has options like VTIAX or VTETF, but understand the trade-offs.
Bottom line.
VTSAX likely covers you sufficiently. Action step. Stick with VTSAX for simplicity and broad exposure. If adding international, use low-cost options and know why.
What if you want the absolute simplest option? No rebalancing, no allocation decisions at all.
Then target retirement funds, TRFs, are your answer. Pick one fund based on your retirement year, like Vanguard Target Retirement 2050. Put money in, done.
How do they work?
There are funds of funds holding VTSAX, VBTLX, international funds, etc. They automatically shift allocation, getting more conservative, more bonds as you near the target date. Slightly higher than just VTSAX, maybe 0.14, 0.16%, but still incredibly low for the convenience. Total hands-off automation.
Any downsides?
Some find them too conservative or aggressive for their taste. Caller prefers individual funds for even lower fees and more control, like avoiding direct international. But TRFs are an excellent, dead simple choice, especially in 401ks.
Action step. Check your 401k for a TRF matching your timeline. Could be the easiest path. But what if VTSAX isn't available? Maybe the minimum is too high or your 401k doesn't offer Vanguard?
Totally common issue. Remember, it's the blueprint, low cost, total stock market index that matters, not the brand name.
So alternatives.
If you can't do VTSX, $10 phase, there's VTSMX, 30K min, slightly higher fee, or VTI, the ETF version, no minimum, same low fee. ETFs trade like stocks, just watch for any commissions.
In a workplace plan.
Look for institutional versions like VITPX, lower fees, no Vanguard. Find the lowest cost total stock market or S&P 500 index fund your plan offers. Always get the employer match first. You can roll it over to an IRA later if needed.
International listeners.
Vanguard is expanding globally. If not available, look for low-cost global index funds like Vanguard's VT ETF, making sure they include U.S. stocks.
Core message. Find the next best thing.
Exactly. Low-cost, diversified, consistent. Action step. Don't let lack of VTSAX stop you. Find the best alternative available and start. Start where you are. Use what you have. Do what you can.
We talk about Vanguard a lot. Why are they special?
Collins answers common questions. 1. What's special? They're owned by investors, not shareholders. They run at cost, aiming for lowest fees. Their interests, your interests. Unique structure.
2. Is it safe putting all money with one company?
Your money is in the funds, separate legal entities, regulated and insured, not tied directly to Vanguard, the company.
3. What if Vanguard gets nuked?
They have disaster recovery plans, multiple sites. If civilization collapses, your portfolio isn't the main worry.
True. 4. Are you paid to promote them?
No. Collins recommends them because he uses them, trusts the model, it works. Simple as that.
Final takeaway on Vanguard.
Build for investors. Low costs, safe, works. Action step. Consider opening an account, choose your index fund, automate, stop worrying.
Okay, we know what to invest in index funds, but where do we put them? The buckets.
Right, think containers. The government offers special tax-advantaged ones.
2 main types.
Ordinary taxable accounts like a regular brokerage, pay taxes on gains dividends annually, best for tax-efficient stuff like VTSAX and cash. And tax-advantaged accounts where the magic happens.
Like 401ks.
Yep. Employer plans, 401k, 403b, TSP, often pre-tax contributions, tax-deferred growth, golden rule. Always get the employer match.
Sure, I might.
Max it out if possible. Watch fees. Roll over to an IRA when you leave the job for more control, except maybe TSP, which has ultra-low fees.
What are IRAs?
Individual retirement accounts. Traditional IRA, pre-tax contribution, tax-deferred growth. And the favorite, Roth IRA.
Why is Roth the favorite?
Contributions are after tax, but growth and withdrawals in retirement are 100% tax-free. Forever. No RMDs either. Huge advantage, especially if you expect to be in a higher tax bracket later. Income limits apply, though.
So, a recommended order.
Generally. 1. 401k up to the match. 2. Fully fund Roth IRA. 3. Go back and max out 401k if possible. 4. Then maybe traditional IRA or taxable account. Adjust based on tax bracket.
Investments are seeds, buckets are the soil.
Perfect analogy. Plant wisely. Action step. Get your 401k match. Open fund a Roth IRA. Check old 401ks for potential rollovers.
But there's a catch with those tax-deferred accounts, right? The RMD surprise.
Ah, yes. You save diligently. Then at age 73, currently, Uncle Sam says time to pay up. Required minimum distribution.
Mandatory withdrawals.
Mandatory. From traditional IRAs, 401ks, miss them, and the penalty is a whopping 50% of what you should have withdrawn.
Ouch. Roth IRAs avoid this.
Yes. Another huge Roth advantage. RMDs sting because they force withdrawals, creating taxable income, potentially pushing you into higher brackets.
So how to manage it?
Plan ahead. One strategy. The retirement tax window. If you retire before RMD age, you might have low-income years. Use that window to convert funds from traditional IRAs to Roth IRAs.
Pay the tax now at a lower rate.
Exactly. Pay taxes now, then it grows tax-free forever in the Roth, no future RMDs. The sooner you start thinking about this and potentially converting, the better.
Proactive planning is key.
Definitely. Use online RMD calculators. Maybe talk to a fee-only planner. Action step. If you're 10-15 years from retirement, estimate future RMDs and start planning conversions if it makes sense.
Okay, one more bucket or tool that sounds amazing. HSAs. Health savings accounts.
Oh yeah, HSAs are like a secret weapon. Triple tax advantage. Yep.
Yeah.
Contributions are tax deductible. 2. Money grows tax-free. 3. Withdrawals for qualified medical expenses are also tax-free. It's incredible.
How do you get one?
You need to have a high-deductible health plan, HDHP. Lower premiums, but you pay more upfront for care. The HSA helps cover that.
But the power move isn't just using it for current bills.
Exactly, the stealth IRA strategy. If you can afford to, pay current medical bills out of pocket. Save the receipts meticulously. Let your HSA money stay invested in low-cost index funds, growing tax-free for decades.
Then reimburse yourself later.
Years, even decades later, tax-free using those old receipts. Plus, after age 65, you can use HSA money for anything without penalty. Just pay regular income tax like a traditional IRA on non-medical withdrawals. It rolls over forever, unlike FSAs.
That sounds almost too good to be legal.
It's legit financial ninja level stuff. Action step. If you have an HDHP, open an HSA that allows investing. Fund it fully. Consider paying small medical bills out of pocket, save receipts, and invest the HSA funds long term.
Amazing. Okay, Section 5, living the free life, putting it all together. Let's use a case study. Collins gives an example. 26-year-old debt-free, $70K salary, $35K inheritance, saving 24%, has a 403B match, wants to use Roth and VTSAX.
Great starting point. First, acknowledge that $35K inheritance is a huge boost. Gratitude first.
Step 1, investment choice.
VTSAX, simple, low-cost, diversified. Perfect. Only fund needed right now.
Step 2, buckets.
Max the 403B, match first, free money. Choose VTSAX if offered there. Then, fully fund a Roth IRA, $6,500 or $7,500 depending on year. At Vanguard, with VTSAX, put the $35K inheritance in a taxable brokerage account, also invested in VTSAX.
Step 3, automate.
Yes. After an emergency fund, automate contributions to the 403B, IRA, and brokerage. Takes emotion out, enforces discipline.
He's saving 24%, which is good.
Good, but what if he saved 50%, living on $35K a year? Collins shows that's rocket fuel. Could potentially reach FII in his mid-30s.
Big warning, though.
Lifestyle inflation. As salary goes up, save more, don't just spend more. That's the silent killer of wealth building.
Final takeaway from the case study.
It's achievable. Discipline, simple plan, patience. One fund, VTSAX, use tax-advantaged accounts, automate. Live below means, stay consistent. Action step. Open that Roth IRA, fund it, automate it, choose VTSAX.
Now, Collins has some strong opinions about investment advisors.
He does. He basically says the vast majority will cost you more than they help.
Why so skeptical?
It's a huge industry built on making investing seem complex. Their interests often aren't aligned with yours. They make money from high fees, commissions, loads, or assets under management, AUM fees.
That 1-2% AUM fee sounds small, but adds up massively over time.
Hugely. Can cost you hundreds of thousands in lost growth. Even commissions on insurance products can be 10%.
So the solution?
Learn it yourself. It's simpler than finding a truly good, low-cost, fee-only advisor, which he says is harder than picking a winning stock. Even Buffett says index funds for 99% of people.
You're capable of managing your own money.
Absolutely. Action step. Learn about low-cost index funds like VTSAX before even considering hiring an advisor. Empower yourself.
Which brings us back to Jack Bogle and index funds. You mentioned Collins regrets ignoring them initially.
Yeah, he admits it cost him potentially hundreds of thousands. Believed the Wall Street myths.
Bogle really flipped the script.
Totally. Created Vanguard, owned by investors, focused on low costs. His S&P 500 index fund let average people own the whole market, not guess.
Wall Street hated it.
Of course. It threatened their high-fee model. But the truth is, index funds consistently beat most active managers. Buffett wants his wife's inheritance in an S&P 500 index fund.
Why do people still bash them?
Greed, ego, psychology. The industry needs you to think you need them. Bogle's gift was simple, effective wealth building for everyone.
Action step. Open Vanguard account. Buy VTSAX or VFIAX S&P 500. Leave it alone. And Collins is equally blunt about picking individual stocks.
Yeah, he learned the hard way. Even working at an investment research firm, seeing brilliant analysts, the edge was razor thin. Information gets priced in instantly.
Or forecasts are just guesses on guesses.
Exactly. He realized he wasn't smarter than the market. Fund managers rarely beat it consistently. The game is rigged against individuals.
Smarter move.
Embrace indexing. Own the whole market. Let it work for you. Action step. Stop trying to pick winners. Invest steadily in a broad, low-cost index fund.
Okay, well, what about dollar cost averaging, DCA? That advice you get when you have a lump sum.
Collins is not a fan of DCA for lump sums.
Why not? It feels safer.
Because the market goes up more often than down, historically, 77% of the time, DCA bets against the odds. It's often market timing based on fear. Market's too high. It also messes up your intended asset allocation while cash sits idle.
So what should you do with a lump sum?
Invest it all at once. Get it working immediately. Maximize time in the market. DCA is already baked into regular investing from paychecks.
If you're too nervous.
Okay, DCA for psychological comfort, but no, it's likely not the best financial move. Lump sum investing usually wins. Action step. If you get a large sum, invest it all at once in your index fund, unless fear prevents it.
Collins has a funny take on becoming a market guru, too.
Ha! Yeah, basically it's not about being right consistently, it's about making bold, extreme predictions.
And waiting for luck.
Exactly. Make enough predictions, eventually one will hit during some market drama, then shout it from the rooftops. Instant fame. Until your next prediction is wrong.
The point being,
Don't take market predictions seriously. Someone is always predicting everything. Focus on your simple, consistent plan. Action step. Turn off financial TV. Automate investments. Enjoy life.
a sobering point he makes. Yes, you can be conned, no matter how smart you are.
Crucial warning. He tells that story about the widow who said, I can't be conned. That's the first sign you can be.
He explains a stock tip scam using probability.
Yeah, sending different predictions to different groups, creating an illusion of genius for the winners. Pure manipulation.
5 rules to avoid cons.
1, everyone's vulnerable. 2, especially in your own field of expertise. 3, cons look trustworthy. 4, best lies mix in truth. 5, if it sounds too good to be true, it absolutely is. Always.
The real danger is the subtle, professional-looking scams.
Exactly. Keep finances simple, transparent, index funds, and talk openly with loved ones. Action step. Have a 15-minute money talk with someone you trust. What you own, why, keep it simple.
Okay, the big payoff question.
Yeah.
You're retired. How much can you actually spend? The 4% rule.
The guideline is you can safely withdraw 4% of your portfolio value in year 1, then adjust that dollar amount for inflation each subsequent year. High chance it lasts 30 plus years.
So $1 million portfolio is $40,000 a year.
Roughly, yeah. Based on the Trinity study, surprisingly, many retirees underspend. The money often keeps growing significantly, even with 4 or 5% withdrawals.
But high fees kill the 4% rule.
Devastated. 1-2% fees drastically lower the success rate. Low-cost index funds are essential. Flexibility is also key, ability to adjust spending if needed.
Action step. Target portfolio 25x annual expenses. Use 3-4% withdrawal rate for safety, maybe more flexible. Stick to low-cost funds. How do you actually do the withdrawal? Living off investments.
Treat all accounts, IRA Roth taxable, as one portfolio. Set up auto transfers to checking or do it manually. Prioritize spending from taxable accounts first. Delay IRA Roth withdrawals. Consider Roth conversions before RMDs.
Collins method.
Spend part-time income first, then taxable VTSX. Adjust based on market cutback and slumps. Spend more in booms. Flexibility is everything. Don't just automate 4% and forget it. Review annually.
Final takeaway. Freedom to live. Adjust as needed. Action step. Log into your accounts. Practice transferring funds. Get comfortable. What about Social Security? Is it secure? When to take it?
Collins was skeptical, but now sees it as more robust than expected. The crisis is real math boomers living longer, means the trust fund depletes around 2033. Taxes cover 75% after that. But the money is real, invested in treasury bonds.
When to take it? 62, FRA 6667, or 70?
Depends on need, life expectancy, break-even 84. Spousal benefits delaying can boost survivor benefit. For under 55s, expect changes. Treat it as a bonus safety net, not the main plan.
Collins advice.
Plan as if it won't be there. Build your own FU money. Treat SS as gravy. Action step. Focus on your own savings first. Enjoy SS as a bonus later.
He also talks about giving back. How to give like a billionaire.
Using donor-advised funds, DAFs, like Vanguard Charitable. Get immediate tax deduction, donate appreciated assets tax-free, funds grow tax-free, you control donations. Great tool for strategic giving.
More important is the joy of giving, like his charity dinner story.
Absolutely. Focus giving, do homework on charities. Direct giving counts too, but no obligation, your choice after securing yourself family. Action step. Pick a cause, give thoughtfully.
Let's wrap up with the 10-year wealth plan he gave his daughter.
A simple, powerful roadmap. 1, avoid debt. 2, surround yourself with financially savvy people. 3, build your career hard early on. 4, don't inflate lifestyle. 5, save invest 50% plus VTSAX. 6, celebrate market drops, buy more. 7, 10-15 years to FI, 25x expenses. 8, game changes work becomes optional. 9, smart choices after FI.
And it's never too late to start this.
Never. Action steps. Start your path now. Low expenses, 50% savings, no debt, VTSAX, consistency.
He shares those inspiring tales from the South Pacific too, people who just went for freedom.
Muck, the hotel owner who figured it out. The sailors rotating work and travel. They chased freedom, using money as the tool.
Lesson. Build your own version of freedom.
Get out of debt, save, invest simply, build FU money. Action step. Define your freedom. Take one small step today.
Final thoughts on risk. It feels scary to invest.
Reframe it. You're not giving up money, you're buying freedom. Investing has risk, yes, but history shows markets rise long-term.
Choose your risk. Short-term volatility, stocks, or long-term decay, cash.
Exactly. Cash feels safe but loses to inflation. Volatility is turbulence, not danger. Decide based on goals, timeline, tolerance. Don't let fear paralyze you.
Collins stayed the course in 2008. Had FU money, gave him confidence.
You have the map now. Knowledge, tools, mindset. Just start. Action steps. Start investing consistently. Automate. Stay the course. Ignore noise. Every dollar buys freedom.
What an incredible deep dive. From wealth is freedom, tackling debt, the power of index funds, building FU money. So what does this all mean? It means you have the power right now to take control, regardless of your past or income.
Spend less. Invest the difference in low-cost index funds. Avoid debt. Stay consistent. That's the core.
And this raises that final important question.
What will you do with the freedom you're building? Colin says, it was never about retirement. It was always about freedom.
Challenge yourself. Envision your freedom and take the next step today.
Hi.
Thanks for joining us on the deep dive. Subscribe for more insights to help you become well-informed and confident. Until next time, keep diving deep.